All right, let's get started. Welcome, everyone. This is a webinar on a risk-managed approach to cryptocurrency, presented by IDX Insights and the Fidelity Digital Assets Group. My name is Andrew Swan, and I'll be your host today. I'm the CEO of IDX, and I'm joined today by my partner, Ben McMillan, the founder and CIO of IDX, as well as Joshua Deems, a Director of Business Development for the Fidelity Digital Assets Group. And for those who aren't familiar, IDX Insights is a quantitative research firm that was founded on the principles of combining academic research with empirical insight to deliver transparent benchmarks for all asset classes around the world. Once a pioneer in hedge fund replication, IDX now delivers these transparent indices to institutional investors and wealth managers alike. Fidelity is one of the world's largest financial institutions, and the Fidelity Digital Assets Group is a team that is pioneering solutions in the secure custody, trade execution, and total risk management of the digital assets industry. Now, before we dive in, it is requisite that we state the obligatory disclosures. This presentation is intended exclusively for financial professionals and has been provided solely for informational purposes and does not constitute an offer or solicitation of an offer or any advice or recommendation regarding the purchase of any securities or other financial instruments and may not be construed as such. The information contained herein may contain hypothetical performance data. Hypothetical or model performance data results may have certain limitations. For example, hypothetical results do not take into account actual trading and market factors such as liquidity disruptions. IDX indexes are available only through third-party investable instruments based on that index. IDX does not recommend, endorse, approve, or otherwise express any opinion regarding any issuer, securities, financial products, or other instruments or trading strategies. All material contained herein is intended for informational purposes only and should not be construed as legal, accounting, tax, investment, or other professional advice. And now for a quick word from this webinar's sponsor. In response to the current and ongoing COVID-19 pandemic, IDX Insights is providing free access to its macroeconomic risk of loss indicator, otherwise known as Merlin, until June 30th of 2020. We are doing this because we believe IDX can make a positive impact in the United States by allowing financial professionals to have access to robust, quantitative insights that inform their decision-making. To learn more about Merlin, visit www.idxinsights.com/Merlin and sign up today for free. No strings attached, no contracts. Once again, if you missed it, that link is www.idxinsights.com/Merlin. And if you have any follow-up questions, please reach out via email to info@idxinsights.com. All right, so let's kick this off. And to get started, I just want to give a little brief background on our panelists today. Ben, I'm going to start with you. Maybe just tell us a little bit about your background, how that evolved into IDX, and what we're going to be talking about today.
Yep. So I'm founder and CIO of IDX Insights, which is a quantitative research and index development firm focused on delivering transparent alternative index solutions. And as you said, my background started with doing some of the early work in hedge fund replication for the institutional marketplace. That evolved to encompass full spectrum of risk premiums across asset classes for the advisor community. So today I'm going to be talking specifically about our IDX Crypto Opportunity Index, which is designed to provide risk-managed exposure to cryptocurrency without requiring the high dollar minimums or accreditation status of some other funds. We'll discuss why we've developed this index, what it seeks to solve for, and most importantly, how it's done since it launched last year.
Thanks, Ben. And Josh, we're super excited to have you on with us today. And for everyone who's listening who might not already be aware, Josh, perhaps you can just give a brief background of yourself and the Fidelity Digital Assets Group.
Yeah, thanks, Andrew. Really excited to be here. So my name is Josh Deems. I am part of a group within Fidelity called Fidelity Digital Assets. And within that group, I'm a director of business development. The group is tasked with building commercially viable products that span Fidelity's foray into the digital asset marketplace, looking at things like custody and trading of Bitcoin and other digital assets. And I spent the last 4 or 5 years of my career on this, previously with State Street, And then before then, did a stint in consulting. But I joined Fidelity in February 2018 to really focus on crypto assets full time.
Yeah, Josh, and this is something we've talked about a lot. And needless to say, you've certainly committed your career to institutionalizing this asset class. And Fidelity's made great stride in doing just that. So I'm going to turn the mic over to you and have you dive into the asset class as well as some of the great things that your team at Fidelity has done thus far.
Great. Thanks, Andrew. So to really kind of level set with everyone, we like to cover a history of digital money and get everyone comfortable with the concept of digital money before we dive into Bitcoin and other types of digital assets. So Bitcoin and digital assets are really not the first attempt at digital money. Back in 1983, David Chaum really introduced this idea to the world with a paper called Blind Signatures for Untraceable Payments. And through the 90s and early 2000s, we saw other efforts that have tried to take currency and basically put it on the internet. Though novel, these early efforts really had specific limitations. The economic, cryptographic, and programming principles, however, that Bitcoin uses were borrowed from previous digital money efforts. However, Bitcoin's also not the last manifestation of a digitally native currency. It's solving for issues that prevented digital assets from being used as a store of value and a medium of exchange. The current financial system uses trusted intermediaries like payment processors and banks to act as middlemen for transactions. However, the trade-off is high fees, surveillance, uptime, and even misplacement of trust. And we see a number of the efforts on this page, like PayPal, Venmo, and Zelle, which are really reliant on the central intermediaries of our banking system to process transactions. Intermediaries also reserve the right to freeze your account and can potentially block transactions as they please, essentially dictating where we are and what we aren't allowed to do with our own money. And Bitcoin, as we'll get into, is really a manifestation of this idea, using some novel cryptographic principles to solve for these types of issues when creating a digital currency. So we believe that some of those trade-offs around banking centralization has really served as the motivation for Bitcoin's creators to remove reliance on trusted intermediaries that misuse this power to varying degrees. So a couple of things to note. Really, dollars haven't been backed by anything tangible since we went off the gold standard in 1971. So where does trust in money come from? Well, most people today trust money because they trust the government. But we only have to look back a few years to see when this trust was challenged. And really, this looks back to poor decisions that were taken by financial institutions and the lack of oversight by the government that led to the 2008 financial crisis. So in the 2008, we had untraceable amounts of debt, lengthy transaction settlement times, global capital centralized among a few large institutions, and really an overdependency on these types of institutions. But we've slowly come back from that. And I think, the infrastructure of our banking system being between 20 to 40 years old, we've evolved in other areas of our economy. The technology that underpins companies like Netflix, Google, and Facebook is only 10 to 15 years old. And so as we push financial services to become more digital, really that's where Bitcoin is really rooted in. So in the first block that was ever created on the Bitcoin blockchain, there's a reference. And that reference is Chancellor on the brink of second bailout for banks. So Bitcoin is really this introduction of a new monetary system that allows for much needed innovation in the capital markets. So an anonymous group of people, essentially that went by the pseudonym Satoshi Nakamoto, introduced the Bitcoin white paper to the world. And I'll just back up a quick second. I've been using some terms interchangeably, both blockchain and Bitcoin. And this paper that was released to the world in October 31st, 2008, doesn't mention blockchain. It's called Bitcoin, a peer-to-peer electronic cash system. But really what it did was come up with this idea of a new type of ledger, new type of database, and a new type of asset that lives on top of that database that allows for the recording of a new type of digital instrument. So whereas blockchain was born out of the same concept, the same system, Bitcoin is the unit of account, the unit of record that the digital instrument, the blockchain stores that can be used for transactions. So Bitcoin is truly digital and truly decentralized. But really what Bitcoin is doing at its core is preventing what is called the double spend problem. And so some of the digital currencies that predate Bitcoin when they were launched, they ran into this issue. And what if I were to take a piece of art and replicate it, right? If I could paint that piece of art perfectly and sell it on the black market, I'm basically inflating the supply and impacting the real scarcity of that asset. And so if you could literally just copy and paste a digital dollar, then you could be your own mint and you could create as many digital dollars as you want without having control of the supply. So the way that this is solved traditionally is through a central intermediary, which we know has its trade-offs. But Bitcoin addresses this using some economics and computer science that allows Bitcoin to address the double spend problem without relying on intermediaries by using its core technology, the blockchain, to record and mint new currency. So let's look at some of the attributes of a robust monetary system that are enabled by Bitcoin's decentralized, trustless, and digitally native design. So attributes of robust money systems, which is an extension of history, humans have always looked to robust money systems to be able to transact. What do we look for when we look at a money? We look for divisibility, portability, scarcity, seizure resistance, and settlement. So from a Bitcoin perspective, Bitcoin is divisible. It can be divided down to 8 decimal places, which is called a Satoshi. It has a 21 million hard supply cap, which is a part of the protocol making it have scarcity. It is portable. You can carry and send it easily across borders without the concern of seizure. So these attributes are combined with a fast, cheap peer-to-peer transaction settlement system via the blockchain. And when the appropriate rules are followed, settlement can happen within 10 minutes, whereas sending dollars via a wire transfer can take somewhere to 1 to 2 business days. And the native unit of this whole system, Bitcoin, provides a stable supply and physical control, while the settlement service, the Bitcoin blockchain, facilitates the low transaction costs, clearing services, and record keeping of the system. These attributes are novel when taken together because they've traditionally been kept separate and operated by separate participants within the global financial system. So let's look at some of the attributes of robust money systems across other types of assets as well. So gold and fiat currencies have important properties, but they do make trade-offs. Gold and fiat cannot perform the function of the other. Historically, gold has been accepted as a robust store of value globally, but gold is not functional as a central asset in a monetary system. If you look at the properties of gold, it's really, gold does have scarcity, but it's really hard to settle a transaction in gold. You don't show up to someone's house and deliver them a wheelbarrow full of gold. However, the dollar solves for this. The dollar is the global reserve currency. It is more divisible and portable, but the expense of being controlled by a central bank and authority. So relative to these two goalposts, both gold and the dollar, Bitcoin combines core properties of both systems in a fundamentally novel structure and provides a resilient path forward for a digital currency that can be used across the globe. So some of these characteristics of Bitcoin have unique properties, right? And so these unique properties make Bitcoin unique from a usage perspective, but it has also created unique investment opportunities for investors and users. And so by virtue of working with different types of investors at Fidelity Digital Assets, we have a unique view on seeing the themes that the investors are looking at as they develop and put Bitcoin within their portfolios. And this is by no means a solicitation of these types of strategies. However, we can glean some insights based on how investment professionals are approaching this space. So a macro investor looks at Bitcoin sort of as a store of value, and that's due to Bitcoin's hard-coded supply cap. A global asset allocator appreciates Bitcoin for the store of value properties, but also looking at its lack of correlation with traditional assets. Our friends at Galaxy Investment Management have a study, and they've shown that the best marginal improvement in a typical portfolio's Sharpe ratio occurs around 0.5% to 2% to Bitcoin. So really, maximizing those risk returns in that general percentage area is what Galaxy has found. For venture investments and venture investors, Bitcoin is really akin to high growth tech companies, exhibiting its asymmetric investment profile, and really as the best performing asset over the last 5 years. And lastly, for thesis driven investors, Bitcoin has been shown to produce alpha generation through unique catalysts that are also inherent to the network, similar to corporate action style events like a halving or a fork. really unique opportunities that investors are looking at, which are different than situations that occur outside of digital assets. So just to double click on a few of these theses, this slide expands some of the attributes we just talked about. So on the far left-hand side of the slide, we're showing Bitcoin returns versus gold in the S&P 500 to show kind of low correlation across 90, 180, and 360 days. In the middle, we're showing back to 2015, if you plotted the returns of Bitcoin against gold, the S&P 500, and three largest tech stocks, Apple, Amazon, and Google, you can see how Bitcoin's price has performed relative to some of the tech stocks and major indices. And then lastly, Bitcoin's supply, we keep talking about this hard-coded supply cap. It mathematically declines every 4 years until it reaches its hard supply cap in the year 2140. But we're actually already at a place, kind of looking now towards January 2020, where Bitcoin's supply is really almost hitting the max. We're going through a major event this May where Bitcoin's new issuance supply will halve again. So decreasing the amount of new monetary issuance to control the inflationary growth of the asset. So large asset managers are deploying capital into digital assets. And this is a key theme that we've seen. And kind of to round out this first bit of education, State Street conducted a survey of 100 asset managers and found that almost 94% of their clients are thinking of making an allocation to digital assets in 2020. And even more powerful, about 70% of the largest asset managers plan to increase their allocations in 2020. So we're continuing to see surveys like this, and we'll point to our own Fidelity survey later on in the presentation, where asset managers, global allocators are paying attention to this asset class and thinking about ways to create exposure for their clients within their portfolios. So there's a number of things, and you could really dive deep into the mechanics behind Bitcoin, but hopefully that gave you an overview of how Bitcoin works at a high level, how investors are starting to think about it. In this next section, we're going to talk a bit more about Bitcoin's adoption and maturation across the institutional space, what market participants are doing, and the infrastructure being built around Bitcoin. And at a base network level, because Bitcoin's based on top of the blockchain, there are some unique insights that can be gleaned from examining the underlying data of the asset. And so in this next section, we'll dive into those sections more broadly. Financial service providers and fintechs have launched businesses that are building new products to facilitate participation in more mature institutional-grade market infrastructure. For example, the Chicago Mercantile Exchange has launched a cash-settled Bitcoin futures product. The Intercontinental Exchange, which is the parent company of the New York Stock Exchange, has launched a futures company as well as a payments business. SIX, the largest exchange in Switzerland, is facilitating trading in digital asset products. And Square, through its Cash App, has been facilitating the transfer and sale of Bitcoin for its retail customers since 2018. And looking broadly beyond financial service providers, traditional investors are also looking at this space. Large global asset managers such as pensions, endowments, and sovereign wealth managers have added digital assets to their investment strategies, either allocating through funds that have strategies around investing in companies that are helping build out the core infrastructure, or high-frequency trading firms that are following the fundamentals and technicals in the market. And the key point here is that these investors are paying attention and are making allocations, whether they be around more venture-style bets on market infrastructure or in the base-level tokens, the digital assets themselves. Interest is showing no sign of slowing across the asset class, and we'll take a deeper dive into both a retail segment and an institutional segment in this slide. So on the left-hand side, we're showing growth in Square's Bitcoin revenue. In the fourth quarter of 2019, Square announced that $178 million in Bitcoin purchases were facilitated via its Cash App, which is an on-ramp for retail investors looking to access Bitcoin. And with the right-hand side of the chart, trading volume of regulated futures products, which are accessed more by institutions, has been trending up as well. We're showing Bitcoin futures volume issued by both Chicago Mercantile Exchange, a traditional market player, and Bakkt, which is a subsidiary of the Intercontinental Exchange, the parent company of the New York Stock Exchange that we mentioned earlier. And they've come online with their regulated futures products as well. And the point here is that we're seeing growth in the Bitcoin adoption from both the retail and institutional segments. So activity is also robust at the base network layer, and really the fundamental on-chain activity is what we're looking at here. So because Bitcoin operates on top of the blockchain and the blockchain is publicly available information, we can really dive in and glean some unique insights from looking at it. And so on the left-hand side here, we're looking at volumes on payment networks, and Bitcoin, being only 10 years old, already processes the same amount of volume as PayPal, though lower compared to Visa and MasterCard, but these solutions have been around for almost 60 years. And, it's a bit unique and not an imperfect comparison because Bitcoin is a native asset and Visa and MasterCard are still processing US dollars. So Bitcoin is that payment and settlement network in one, whereas Visa and MasterCard are relying on a central intermediary to process transactions. You're not directly paying merchants in Visa bucks or MasterCard bucks. However, we use this to present a frame of reference, as we do think payments is a key use case for Bitcoin in the future. On the right-hand side of the screen, we're able to actually get a good glimpse of the number of addresses that hold Bitcoin on the network. Now, we see here that there's almost 30 million addresses. An address is really an individual instance of your connection point to the Bitcoin network, but it also is a stamp of ownership of Bitcoin. So an address is really any associated person or institution that owns Bitcoin on the network. And we're seeing about 30 million addresses as of March 5th, which is continuously hitting new all-time highs as we're learning that more people are entering the space and participating in the network. So we've spent some time learning about Bitcoin and how Bitcoin operates, and also looking at what institutions and what retail participants are looking at and doing when participating within the network. Fidelity's been looking at this space for quite a long time, and I'd like to spend the next couple of minutes going over what Fidelity is doing in the crypto space and what Fidelity Digital Assets means as a new commercial entity. So Fidelity spent quite some time researching both Bitcoin and blockchain as concepts, dating back to February 2014 when we conducted initial research. And that initial research was really digging into what frictionless capital markets can look like. And Bitcoin and blockchain was the impetus for us to spend more time understanding how Bitcoin could impact our overall business lines. And we started proofs of concept. We started mining Bitcoin. We started accepting Bitcoin as a form of charitable donation. We also allow our associates to pay for things in the cafeteria with Bitcoin. And understanding the new creation of this asset, how this asset could be donated, how this asset could be traded, really gave us this deep understanding of forming a commercial unit around it. And it was this combined with some customer research that we'll highlight in the next 2 pages that really led to the birth of Fidelity Digital Assets as a new business line within Fidelity Investments. So as we thought about launching this new business, we conducted a survey and we commissioned about 400 institutional investors, including hedge funds, financial advisors, pensions, and endowments to answer some questions about Bitcoin or digital assets and their roles in their portfolios. And we learned that nearly half, about 47% of investors that we surveyed, view digital assets as having a place in investment portfolios, with 32% of the folks we surveyed seeing it as a part of an alternative asset class, and 15% viewing it as its own independent asset class. So these are the aspects that institutional investors found appealing about digital assets. 47% found it as an innovative tech play. 46% found its uncorrelation to other assets as appealing. 27% said the high potential upside, and then 25% saying, the mission of decentralization was quite important to them. And then we listened and also learned that nearly 20% of all investors have some exposure to digital assets today. So the culmination of this work and research that we've done and listening to our clients led us to launch Fidelity Digital Assets. And we launched this business on October 15, 2018, envisioning a future for all types of assets to be issued natively on a blockchain or represented in a tokenized format. In order to do that, we've decided to build what we believe is the pyramid, the base of the pyramid, in the form of a custody service. So our customers can deposit their Bitcoin with Fidelity, and we'll safeguard those assets for them. given Bitcoin is a digital bearer instrument in the same way, a dollar bill is a physical bearer instrument. If you lose the private password of that Bitcoin, you're essentially losing that Bitcoin forever. So custody is an extremely important part of a risk management framework when you're operating and interacting with these assets. And that's why we decided to base our service offering around a custody platform. On top of custody, we have a trade execution facility. This allows our customers to access multiple venues of liquidity while not needing to move those Bitcoin assets off of our platform. We're leveraging technology, including an internal crossing engine and a smart order router to fulfill client orders, and really taking a position that helps limit an exposure of our clients' assets to credit risk by handling the settlement processes and the delivery processes of Bitcoin and US dollars for all transactions that are happening on our platform. And so really, these are our two core offerings right now. We're going to expand those offerings and the types of assets that we cover over the course of the next few months and years. But wrapped around these products are client service and risk management. And client service is central and core to everything that Fidelity does, and that's no different here. We have a white glove onboarding service. We have dedicated relationship management. We have extended customer support hours, really to help our customers navigate the challenges that come with just any sort of new type of asset. And really, we're spending a lot of time and resources getting our client service team to be able to handle any type of inquiry that a customer could have around these types of assets. And lastly, risk management, which is core and central to everything we do. We're using a robust combination of operational, cyber, and physical controls and leveraging an enterprise framework. And that framework includes those controls, but also insurance and capitalization. And lastly, we also just received a SOC 1 Type 2 audit report from a Big Four accounting firm, and that really is an attestation to the control frameworks that we've built. We'll look to leverage relationships with these accounting firms in auditing as we continue to grow our business and scale to new products and services to make sure that what we're doing meets a standard that's been set in other traditional industries.
Thanks, Josh. That was a great overview of the asset class of cryptocurrencies and the evolution that's occurred over the last decade, and really what Fidelity has done to bridge the gap of institutionalization such that more and more individuals can participate in the growth of the asset class, but do so securely and safely. And I'd like to take this time to now transition over to Ben McMillan, the CIO of IDX Insights, and talk a little bit more about that last point you made, Josh, which is risk management, and ultimately how you can apply systematic rules-based approaches to risk management to this asset class to hopefully allow individuals to gain exposure to this asset class and the growth that's to come in the years ahead without having to endure significant drawdowns that are beyond their comfort zone. And when I say individuals, I'm not just talking about the ultra wealthy or the accredited investor. I'm talking about everyday investors that financial advisors work with, your clients, and ultimately trying to generate solutions that give them access and solve problems for wealth managers too. So, Ben, I'll turn the mic over to you to share with everyone some insights on how we approach this asset class at IDX.
Yeah, so one of the things that's most compelling about frontier markets, like crypto assets, is that there's inherently a lot of opportunity, but with that comes a lot of risk. And it's not just market risk and statistics around that we'll get into. It's also infrastructure risk and all the things that Josh talked about, things like custody, things like trading. So if you go back just a couple of years ago in the crypto markets, it was still very much the Wild West around that. So even if there was an appetite and a strategy, it wasn't necessarily the case that it could be prudently deployed. One of the things we're very focused at in everything we do at IDX, which is core and central to our beliefs, is risk management. And again, that's not just market risk management, that's risk management around the deployment of our different strategies. And so that's why this level of institutionalization that's happened in the crypto space in the last few years has been nothing short of exciting, because it really democratizes the landscape and the access that investors can now approach this asset class with in a prudent fashion. Now, that said, one of the biggest, perhaps the biggest criticism of Bitcoin as an asset class is its historic volatility. So while it obviously demonstrates some of the key appeals as other alternative asset classes, such as low correlation to stock and bond indices, the question is the volatility just simply too high to justify the benefit? And that's a very real concern because, as we know, downside volatility is mathematically worse than upside volatility. The further you fall, the harder it is to climb back up. Now, for most asset classes over time, the order of magnitude of drawdowns has been such that this asymmetric relationship between downside and upside gains hasn't been as apparent. If you're down 5%, you only need to be up 5.26% to get back to even. Similarly, as you're down 10%, you only need 11% to get back to even, and so on. The inflection point, however, happens when you're down 50%, at which point you need to double your money to get back to even. So we're no longer talking about percentages, we're now talking about multiples. As we all know, post-2008, a lot of investors started revisiting the stark reality of this math, and therefore the importance of controlling for drawdowns, because once you move beyond this inflection point, the math literally gets exponentially worse. If an asset is down 90%, you have to be up 900% just to get back to break even. So our view is that anybody considering Bitcoin as an investment really needs to focus on the distribution of outcomes in the bottom half of this table.
Yeah, Ben, that's a very valid point because in this asset class in particular, seeing 75 to 90% drawdowns is not uncommon. In fact, we had one last year to the magnitude of around 80% peak to trough. So it's something that shouldn't be taken lightly and certainly considered when you look at owning this particular asset class.
Exactly. And to your point, just last year, we saw a drawdown of over 80% in both Bitcoin, which is shown here in the graph in gold, as well as the Grayscale Bitcoin Trust, shown in gray. One quick note, this graph starts after the inception of the Grayscale Bitcoin Trust because that's what we're going to be talking about in this presentation, but anybody who's followed Bitcoin for any length of time knows that it's no stranger to drawdowns of this order of magnitude.
Well, this is especially pertinent now, given that we're experiencing volatility on a level not seen since the financial crisis. And in a world with low forward-looking returns on traditional asset classes, Bitcoin as a potentially uncorrelated source of return, particularly with its increased institutionalization, still has a lot of appeal. The question is long only the only way? And Ben, what investors want to know is, how else can they approach the asset class? Is there a way that they can control these drawdowns?
Yeah, and that really is the question as it relates to Bitcoin as an investment. And we would submit that the answer is no. Long only isn't the only alternative. And in particular, momentum-based models are a very good candidate for taming highly volatile asset classes. This is a slide that we're looking at from Dr. Jan Weibig of Harcourt, which actually shows one of the most powerful empirical results of momentum strategies, which is their ability to generate a convex payout profile from highly volatile assets. So in general, markets that are characterized by high volatility, but also specifically fat tails, what mathematicians would call leptokurtic distributions, are very good opportunity sets for momentum-based strategies. More importantly, these strategies have a lot of empirical evidence behind them. We're not just relying purely on academic theory. We have decades, in some cases, several decades of data to rely on and to observe how different types of momentum strategies have behaved in different asset classes, different geographies, and different time frames. So further to the point, aside from the fact that Bitcoin is a highly volatile asset class, it's also one that's largely driven by price action as opposed to quote-unquote fundamentals at this point. That's not to say that there isn't fundamentals behind Bitcoin and blockchain and things like that, but it's not nearly on the order of magnitude as other asset classes such as commodities, fixed income, or equities. So this is another reason that makes it an appealing candidate for a momentum-based strategy. Finally, the last thing I'll say about this is one of the other big appeals to us at IDX in thinking about how to develop types of investable indices for this asset class is simply the robustness of the momentum signal. The fact that momentum works pretty well, quote unquote, out of the box is hugely appealing to us when we're balancing model sophistication with model fragility. So initially, we actually developed an early version of this index to solve our own problem of how we could get risk-controlled exposure to Bitcoin in a systematic way that could still participate in the upside, but with a focus on mitigating that drawdown. Concurrently, we started seeing a lot of growing demand from the advisor community facing the same problem, and so we launched the Crypto Opportunity Index. Now, a couple of things about this model. The model goes long or flat, the Grayscale Bitcoin Trust, so there is basis risk between GBTC and spot Bitcoin. I also want to emphasize that this is not just a simple trend following strategy. We are using momentum, but we're also looking at the momentum of momentum
to determine whether or not to go long the Grayscale Bitcoin Trust. So simply stated, what that means is that this model requires that both momentum be positive but also increasing in order to generate a long signal. Otherwise, the model is allocated to our cash position, which in this case is a diversified basket of fixed income ETFs. The key idea here behind this construction is that we want to place a premium on drawdown control over return capture. So to help illustrate the mechanics of this model, I want to drill down on when it takes its exposure. So the graph we're looking at here shows the performance of GBTC in the gray line, with the blue bars representing the average monthly allocation of just the pure momentum piece of the model. So that's just one of the two signals. So if we were just using a simple trend following strategy, it would be allocated to GBTC almost 60% of the time, with most of that exposure concentrated around the rising prices, which you can see. Now, if we isolate just the second component of the model, which is the acceleration component, we see that it's much more active, but it's allocated to GBTC slightly less overall, only 52% on average. Now, when we combine these two models, we get our crypto opportunity index. And what's most notable about this strategy is how judicious it is with its allocation to GBTC. You'll notice it's only long roughly 1/3 of the time because it requires both of the previous signals to be on. Now, I want to focus for a minute on why we're looking at exposure first. And the reason is because that's the primary objective function of this model, is when and how it takes exposure to GBTC. The expected performance from this exposure is purely a secondary consideration to the risk control. And this gets behind the idea of capital efficiency. Remember, the objective of the index is to participate in Bitcoin, but to do so without taking what we deem a necessary risk. Therefore, the threshold for going long is relatively high, but the threshold for getting flat is very low. So now let's look at some of the different performance characteristics of each of these models relative to a simple long-only GBTC allocation. Now, I want to emphasize here and fully disclaim that what we are looking at is largely hypothetical model data, but it is instructive for understanding the mechanics and the dependencies of these different models. So over this period, a simple long-only allocation to GBTC would have returned 567% in total. The momentum-only model would have been active only about 60% of the time and actually would have returned over 600%. Looking at the acceleration model purely by itself, you'll see that it was even less active, but also less effective at the upside capture. When we combine these two models, we see that the coin index was able to return 486% over this period, starting in 2016, but it was only allocated to GBTC, as we saw, roughly 1/3 of the time. So that's hugely efficient from a capital perspective, and one of the key objectives of this model. Now, these statistics mean little in isolation, so we also want to look at the percentage of up months versus down months, and specifically that ratio, i.e. the hit rate. This is where the power of combining both momentum and acceleration becomes evident. Similarly, when we go back to the total return number and decompose it by total upside versus total downside return, we observe a similar capital efficiency in how the coin model allocates its risk budget. And then finally, we can take a look at the best and worst month, and we see a similar story play out. So the point to be made from all this is that we can't underscore enough how important it is that a very different risk-return profile can be manufactured relative to just a simple long-only allocation with fairly straightforward, very robust implementations. So for investors that are worried about capturing all the upside, this is not the approach to take. That would just be a 100% pure GBTC allocation. To be clear, this model is designed for those that are looking for very selective exposure in when and how they get access to Bitcoin. Now in this chart, we see that same convexity that we saw before, but now this is the coin model relative to the Grayscale Bitcoin Trust. Note, because this is a long flat strategy, we don't see the full smile because there's no outcome designed to make money when GBTC is down, but it does a very good job of highlighting the exponential nature of that payoff function. Now, much of what we've been looking at has been hypothetical data, as I've mentioned, but we did start running this model live with outside money on June 1st of last year. So we have been able to observe some pretty meaningful out-of-sample statistics since that go-live date. Specifically, the model was very effective at mitigating the drawdown in GBTC in Q4, and then even more recently last month, consistent with what we saw in the hypothetical data. So that's a good sign. Focusing on just the period of live performance, we see the cumulative performance of the coin model in blue relative to GBTC. And the bars, again, that we're looking at in the background are the average monthly allocation of the coin model to the Grayscale Bitcoin Trust. So you see a meaningful ability for the model real-time out of sample to generate risk-controlled exposure to Bitcoin, in this case via the Grayscale Bitcoin Trust, in a way that we think has very useful portfolio applications.
Yeah, those are great insights. And for our listeners, Ben, perhaps you can just take a quick minute before we get into Q&A and summarize your final thoughts on the asset class and the particular approach that coin takes.
So I think there's really two key takeaways here today. The first one is that, as Fidelity demonstrated, the institutionalization of Bitcoin has already happened. But that in and of itself isn't a sufficient condition for inclusion in most portfolios. We think that any prudent approach to investing in the asset class has to be risk managed, systematic, and robust. If you can focus on controlling those outcomes which can be controlled, then we think the result is a very compelling addition to most portfolios or most alt sleeves in portfolios. As the saying goes, manage the downside and the upside will take care of itself.
Great. Thanks, Ben. And thank you, Josh, as well. And for everyone who tuned in today and is listening live, we'd like to thank you for also joining us. We certainly hope you found it informative and useful. And we are now concluding this presentation. However, we're about to kick into Q&A. So we've been accumulating questions throughout the entire presentation. We're going to give everyone a few minutes to lob in the last few questions that they may have. And then we'll spend the next 5 to 10 minutes fielding those questions. So don't forget to lob those in. In the meantime, if you have any follow-up questions for IDX or Fidelity and you'd like to reach out to us afterwards independently, you can reach IDX by contacting Ben Jacobson, President of Investor Relations. His email is benjacobson@idxadvisors.com. His phone is 951-541-3959. And if you'd like to reach out to Fidelity, you can reach Joshua Deems, Director of Business Development, who is on with us today. His email is joshua.deems@fmr.com, and his phone is 774-274-0334.